Morning YouTube, Louie here, and welcome to the weekend. Today I want to talk about what has happened historically to the price of silver during stock market crashes. I am on goldsilver.com. I believe this is Mike Maloney's website. So they sell precious metals, and they have an article here. You would think it would be bullish as to silver and gold, but it's really quite mixed. And I think this information might be helpful to you in assessing where the price of silver is going if we are in a recession. At the end of the video, I'll talk a little bit about why I think we are in a recession and why I think it's going to be a deep and long recession. But you may not think so. You may think we're in a soft landing and whatnot. And if that's the case, then this would not be that interesting to you. But let me give you the upshot. Okay, in stock market crashes, generally gold does well, preserves your purchasing power, or appreciates. Okay, that's the gist of the article. He's analyzed, I don't know, about 8 or 9 crashes here since 1978. And gold is definitely the star. If you've been buying gold, then you're in the club that believes that gold is going to do okay in a recession. However, silver has a very negative history during stock market crashes. All right. Now, there is a big negative here on gold in 1980, but appreciation prior to 1980 had been, let's see, gold rose more than 2,300% from its low in 1970 to the 1980s peak. Okay, so that was after they took us off the gold standard and so forth, and gold was unpegged, and it rocketed higher after that. So I don't know that I would pay much attention to anything 1980 or prior, but let's take a look at silver. Okay, silver is considered a commodity by many. I know it's a currency to many of us, and definitely a store of wealth. But here are the results. Okay, this is from Mike Maloney's website, and I presume that the information is correct. May not be. You can double check it. The 1987 crash, silver lost 11.8%. The 1990 crash, silver lost 10.8%. The 1998 crash, silver lost 9.5%. The 2000 crash, .com crash, silver lost 14.4%. Here we have an up year in the 2007 to 2009 period. It went up 1.1%. In 2011 crash, silver had a 19.1% decline. And most recently in 2020, silver had a 31.8% decline. So, averaging all those together, on average, silver declined 16.4% during stock market crashes. And let's see if there's a little more. I'll read you the paragraph here. Silver did not fare so well during stock market crashes. In fact, it rose only in one of the S&P sell-offs and was basically flat in another one. This is likely due to silver's high industrial use, about 56% of total supply, and the stock market sell-offs are usually associated with a poor or deteriorating economy. And we'll get to that at the end of this piece. However, you'll see that silver fell less than the S&P in all but one crash. This is significant because silver's high volatility would normally cause it to fall more. Also notice that silver's biggest rise, 15%, was in 1970s, took place amidst its biggest bull market in history. It also ended flat by the end of the financial crisis in 2009, which was its second biggest bull market. In other words, we have historical precedents that silver could do well in a stock market crash if it is already in a bull market. Otherwise, it could struggle. Okay, and gold, the yin to silver's yang. Obviously, gold performs much better. So there is the comparatives of gold to other assets during stock market crashes. Um, well, you see, gold outperforms or preserves wealth. Let's see if there's anything else here on silver. All right, so the takeaway is that you pretty much have to be in a roaring bull market for silver to continue to appreciate during a stock market crash. If you're not, then you can expect declines in the price of silver. And that is kind of what we have seen. We definitely have had a sell off recently, sub 20. Right now, we're pushing 21. And people seem to be thinking, of course, a nice bounce in the stock market and a little bounce in precious metals. You'd have to ask yourself, I think, if the market can recoup that much of its losses, why is silver still hanging under 21? Well, I believe it's the risk of recession. I believe that, of course, we've had the two negative quarters of GDP, and I think the recession is going to be deeper, and I think it's going to be longer, and I think that will put a cap on the price of silver. All right, why do I think that? Well, inflation is certainly robbing people's purchasing power, and people are struggling more and more to pay their bills. And in fact, credit card balances are increasing. We know that when everything gets more expensive, you buy the necessities and you don't buy the luxuries. All right, I don't think that dynamic has changed. Although we had a fractional reduction in the CPI, which I predicted, I really didn't think a little teeny reduction from the high levels that we're at would cause the market to go on a buying spree. I think it's actually quite foolish to think that CPI and PPI, where they are now, translate into a robust economy and will restore the earnings power of corporations. I do believe that inflation will come down over the next several quarters, but it has still done a lot of damage. All right, what else has done damage that's pretty much unfixable? High mortgage rates. Okay, mortgage rates in the 5 to 5.5% range are definitely impacting the housing market and new housing projects. So housing is extremely strong. You could say housing is in a bubble. Well, why do I say that? Well, prices seem to be nearly double. Maybe not double, but we're probably up, don't quote me on this, 50% from the peak of the last housing bubble. All right. So, what happened last time? Well, we had a dramatic reduction in the price of houses. People had their home equity lines called, and it became a buyer's market. Now, in this market, we have a lot of corporations that own houses. The new American dream is for a corporation to buy a house and rent it to you. I'm not so much in favor of that. But eventually, the corporations will puke up these houses as well. So I'm expecting the price of housing to fall. All right. What do we have in terms of the debt market? Well, you know the debt market is out of control, and how do we fix it? We fix it by spending more and printing more. It's virtually irrecoverable in order to get out of this debt bubble we're in. What will cause it to pop? Well, we'll have to see where that starts and if that infects the entire market. But I actually expect something like that. I think the next drop in the stock markets could be associated with some kind of event. Events are very useful to our government and to the Federal Reserve in order to push the guilt. The smoking gun becomes someone else's fault. It becomes Lehman Brothers' fault. It becomes the Wuhan labs' fault. It becomes anything other than what they have done. Well, we've pumped up the money supply, and I don't think that can continue. I think many people agree with that, and there's going to be some kind of a bloodletting when it comes to the debt that's out there. This is the other reason that you need to be careful in the banks. A lot of stories coming out about banks restricting withdrawals, et cetera, et cetera. So I think you want to have large sums of cash out of your local bank. But where will the debt bubble end? And inflation makes it very difficult for the Fed to curtail the debt bubble makes it very difficult for the Fed to curtail inflation. I think the only way that they curtail inflation is not so much through interest rates. No, I don't think they're going to pull a Paul Volcker. I don't think the government could pay those high rates and stay solvent. I think they're going to do so by crashing the economy, by crashing personal income, by bringing on a deep recession, and that will deflate asset prices, and then that will do the work for them. Now they may not do that through higher rates. I think we may have another 50 or 75 basis point hike coming, but it's the balance sheet. All right. They have tremendous power in the amount of assets they have on the balance sheet. So if they want to bring down the market, all they have to do is start selling off all the debt that they've purchased. If they want to goose the market, well, then they can start buying more. But personally, I don't expect long rates or short rates to go a lot higher. I think bonds are actually the investment of the day. As the stock market crashes, as the economy crashes, bonds usually do well. So ultimately, there will be some kind of a blow up, and you won't want to be in bonds. But for right now, I would definitely be in bonds before I would be in the stock market under the illusion that we're going to have a soft landing. What's happening with jobs? Well, a lot of the better paying jobs, not necessarily the Taco Bell jobs and so forth, but the high end jobs, well, the Fortune 500 are cutting those jobs. What happens when somebody loses a job at, Google or Apple or Tesla? And it's a two income family, and they just bought a very, very expensive house at 5.5% mortgage, and someone loses their job. Well, I'll tell you what happens. That house goes on the market. All right, because if you mess around with that, you're going to go into bankruptcy and foreclosure, and that is a very, very negative thing. So watch the job market. I think that is an indication and a lagging indicator. Um, they don't report it, until later, so people don't see the unemployment rate rising, and it appears strong right now. But you have to ask yourself, what's strong? Jobs at Google and jobs at Tesla, or jobs at Taco Bell? Right? And are they part-time jobs or full-time jobs? So if I've just gone out and gotten a second job at, Taco Bell or the Amazon warehouse, that may reduce the unemployment figures, but that ain't a job at Google. And I think you're going to see the middle class and upper middle class get gored here. It is a complete setup, very, very similar to 2007, 2008. And I don't know what'll get us: the housing market, the debt market, the job market, the high inflation. But it is very hard to find a silver lining in what's happening right now. And I think the equity markets will roll over here, and I think they'll go lower. But time will tell. People disagree. I saw a poll recently where 75% of people thought the bottom was in for the stock market. See a lot of videos saying the bottom is in for silver. Um, will there be a supply crunch? Will the COMEX get drained? Well, all I would say is inventories drop when something is not in demand, and it could be that. So if the SLV is under distribution, and it is certainly in July, and people are selling their SLV shares, theoretically, that should relate to a distribution, over at the LBMA as well. So I don't know, if this is silver running out, or if this is actually the indication that we're in a silver bear market right now. Gold is looking much stronger, and I think I can see the reason why the GSR has been up around 90, and that's also reflecting recession. So you decide: are we in recession? Are we in having a soft landing? And whether or not you want to heed this warning, I think it is wise to stay very skeptical and look for the deals. And just because a billionaire is buying some silver, guys, I wonder when we as a community will stop glorifying people that are doing us harm. All right, whether it was the silver squeeze, which actually did tremendous harm to the stacker community, both in terms of premiums and disillusionment, or whether it is a billionaire trying to convince us that prices are going higher as they buy, or whether it is the big bullion companies and the A-Mark Borg that keep premiums high, or whether it is the Sunshine Mint sending all their product over to JM Bullion and then telling the US Mint they can't supply planchets. I think we should stop glorifying people and institutions that are raising our prices and making it more difficult for us to buy product. You could buy silver all day long at 21 if you can find a decent premium on it. I do think it's headed lower, but don't follow the herd. Do your own analysis and determine if rising premiums and hype stories are doing us any good as a community. Okay, I'm going to leave it there. Hope you guys have a great weekend. Lots to consider here. I would love to hear your response. Are we in a shallow recession? Are we moving into a deeper recession? Do you think the economy can survive where we're at right now? Do you think the Fed has pivoted? Do you think that they are going to engage in quantitative easing and send the stock market, up to 60,000? I mean, all those things can happen, but when they happen is what's relevant. Right now, recession, in my opinion, heading to deeper recession, heading to market sell offs across the board, debt bubbles bursting, and silver languishing. That's where I am. Where are you? Okay, guys, I'll talk to you later. Louie out. Oops.